Hong Kong is one of the world's most successful financial hubs, a status it has maintained for a very long time. But did you know that Hong Kong is one of the only few countries in the entire world that pegs their own national currency, the Hong Kong dollar to the United States dollar? This has occurred for decades. Here's a graph on the official exchange rate of the Hong Kong dollar to the US dollar. You can see that from 1984 to the latest data for 2023, the Hong Kong dollar is pegged to the US dollar at a fixed exchange rate of 7.8 Hong Kong dollars to 1 US dollar. Sometimes it fluctuates, but it is mostly at this level. This exchange rate is quite unique, and only a few countries globally do it. To many observers, however, Hong Kong's currency peg may seem very weird. It raises important questions for many people. Why peg a currency to the US dollar? Shouldn't it be allowed to float freely like many others? After all, a free-floating currency reflects the true value of a nation's economy in the global market. It adjusts naturally based on supply and demand, and many believe it grants more flexibility in addressing local economic challenges. So, why does Hong Kong do it? Why do they peg their currency? Well, to understand that, it is first important to understand the historical context of Hong Kong's currency peg. During the second half of the 20th century, Hong Kong transformed itself from a small port city into a global manufacturing center and eventually a financial hub. The US dollar peg occurred in the early 1980s. But before that happened, there was a major event that occurred in the 1970s. Back then, many global currencies, including the British pound, were floating or pegged to the US dollar in some manner following the collapse of the Bretton Woods system. Hong Kong, with its significant trade exposure to the United States, began to see the USD as a more stable reference point than sterling. And the crucial turning point came in 1983. At the time, there was rising political uncertainty over Hong Kong's future. The Sino-British Joint Declaration, signed in 1984, was being negotiated, outlining the handover of Hong Kong from British to Chinese sovereignty in 1997. This uncertain political environment caused capital flight from Hong Kong. Investors feared potential instability after 1997. The Hong Kong dollar depreciated sharply, and confidence in the currency wavered. That is why, if you take a look at the official exchange rate graph, you get to see that in the early 1980s, the Hong Kong dollar in every single year was depreciating in value, jumping from 4.98 Hong Kong dollars to 1 US dollar in 1980, to over 5.59 Hong Kong dollars to the dollar in 1981, then 7.27 Hong Kong dollars to the dollar in 1983, and to where it was pegged in 1984. But in the year it was pegged, the decision was driven because the Hong Kong government wanted to restore trust and stability in the local currency. That measure effectively ensured that any holders of Hong Kong dollars could be confident that their money would maintain a stable value relative to what was then the world's most prominent currency. By anchoring to the USD, Hong Kong policymakers also signaled to global investors that they would not let the Hong Kong dollar become a volatile or weak currency. The peg, in hindsight, was an essential measure for shoring up international confidence in Hong Kong's future. Indeed, the region's economy grew rapidly over the ensuing decades, propelled by trade, finance, and real estate, all underpinned by a stable exchange rate. Here's a graph on Hong Kong's nominal GDP, data from the World Bank. Here you can see that from 1962 to 1983, the economy of Hong Kong was growing steadily. But there wasn't any exceptional growth seen. Moreover, you can even see the nominal GDP to decline in 1983. But if we extend this graph into further years, we get to see a huge difference. You get to see that Hong Kong's nominal GDP exploded. In 1983, before the peg occurred, Hong Kong's GDP stood at only $29.91 billion, but just a decade later, by 1993, it rose to a massive $120.35 billion. This currency peg was then important for Hong Kong's economy. So now, let's talk about how this works. How does Hong Kong actually peg their national currency to the US dollar? This is not an easy thing to do. A currency that floats freely is subject to the forces of supply and demand in the foreign exchange market. When a currency is pegged, however, the government or central monetary authority must actively manage its value to maintain the fixed exchange rate. In Hong Kong's case, the responsibility falls into the hands of the Hong Kong Monetary Authority, HKMA, which uses a series of tools and rules that are collectively known as the linked exchange rate system. The very first tool that they use is the convertibility undertaking. The HKMA promises that it will buy US dollars from licensed banks at the strong side convertibility rate. For instance, 7.75 Hong Kong dollars per US dollar, and sell US dollars at the weak side convertibility rate. For instance, 7.85 Hong Kong dollars per US dollar. This creates a trading band that prevents the Hong Kong dollar from appreciably straying outside this range. Secondly, there's also the interest rate adjustments. If demand for the Hong Kong dollar increases, perhaps due to capital inflows, the HKMA can lower local interest rates to dissuade further inflows. Conversely, if demand for the Hong Kong dollar decreases, the Hong Kong Monetary Authority can raise local interest rates to attract capital. This interest rate lever helps keep the exchange rate stable without the HKMA constantly having to dip into its reserves. Thirdly, it is well known that the Hong Kong Monetary Authority holds substantial reserves of US dollars and dollar-denominated assets. Here's a graph on Hong Kong's total reserves, data from the World Bank. Here, you can see that as of the latest data available, Hong Kong has over 425 billion US dollars in foreign reserves. That is no small figure, and it is a figure that is much more than Hong Kong's GDP. These reserves help ensure that, in the event of a sudden capital flight, the HKMA can defend the currency peg by supplying US dollars to the market. Now, let's talk about the effects of this peg to Hong Kong's economy. As we mentioned earlier, after 1984, Hong Kong's economy started to explode in growth. Amongst the key reasons for the positive effect of that peg was because Hong Kong was able to show strong macroeconomic stability to foreign investors. Anyone setting up a business in Hong Kong or investing in its capital markets can effectively treat the Hong Kong dollar as if it were a near substitute for the US dollar, at least in terms of exchange rate risk. That is basically why Hong Kong consistently ranks at or near the top spot of economic freedom, partly because of its stable monetary environment. This stability lowers transaction costs for businesses. Hedging foreign exchange risks is simplified. Financial contracts can be written with greater certainty, and businesses can plan longer term without worrying that a 10% or 20% currency swing will wipe out their profit margins. However, the flip side of a currency peg is that Hong Kong imports the monetary policy of the United States. Since the Hong Kong dollar is fixed to the US dollar, local interest rates must loosely follow the Federal Reserve's policy rates. If the Fed raises interest rates, Hong Kong's rates go up as well, even if the local economic conditions in Hong Kong don't necessarily warrant such an increase. Here's a graph on the interest rate of Hong Kong, data from the Hong Kong Monetary Authority. Here, you can see that the interest rates have gone up and down, depending on the economic landscape. But if we add the United States interest rate on the graph right here, we get to see that the US interest and Hong Kong interest rates are closely aligned. This dynamic can cause periods of asset inflation, particularly in real estate, when US rates are low and capital is plentiful. Hong Kong's small and land-constrained housing market can see huge price surges when borrowing costs are low. Here's a graph on the average price of private permanent housing flats in Hong Kong. Here you can see that the cost has increased rapidly. In Hong Kong Island, it was only $49,237 per square metre in 2006, but by 2021, it rose massively to over $186,347. The reflection of this cost increase is housing affordability. Hong Kong is always reported to be amongst the most unaffordable places in the world to own a home. For instance, here's a graph on the least affordable markets in the world. You can see that Hong Kong far surpasses other major markets like Sydney of Australia, Los Angeles of the United States, and Singapore by a far. Hong Kong for 2022 had a price-to-income ratio of over 18.8. What that means is that it takes more than 18 years of the average household's annual income to afford a home in Hong Kong. This is far higher than other cities like Sydney, Los Angeles, or Singapore, making Hong Kong the least affordable housing market globally. This relationship between low interest rates and high property prices has led to concerns about housing affordability. For many Hong Kong residents, a small 200 to 300 square foot apartment can cost hundreds of thousands to over $1 million, depending on location. The peg constrains the government's ability to raise local interest rates independently to cool the property market, so the authorities rely on measures like higher down payment requirements or additional taxes on non-resident buyers. On the positive impacts, one could see that trade plays a role. Hong Kong has always been a major trade entrepot, connecting mainland China with the rest of the world. A stable exchange rate to the US dollar helps facilitate this role, especially given that the US dollar is the dominant currency in international trade. That is why, if we take a look at the graph right here on Hong Kong's merchandise trade, as a percentage of GDP, we get to see that it is very, very big. In 2023, the latest year available, it is over 322%. That is actually the highest in the entire world. Here's a graph on the world's largest for this data set. Here, you can see that Hong Kong's merchandise trade far surpasses Singapore, which is a well-known major trade hub. Hong Kong's currency peg to the US dollar is a prime example of how a monetary policy arrangement can shape an entire economy, for better and for worse. But anyway, do let us know what you think. Thanks for watching.